have another raised hand from R.K. Gupta ji. I will just quickly ask him to share what he wants to add.
First of all, very good morning, Anil Goel ji and Ankit Goel ji. I hope I am audible.
Very much.
Yes, you are audible. Thank
Okay.
you.
So the only question I would ask is that at times there is a change in the management of NBFCs. And being an auditor, basically, this question is from an auditor's perspective that if a person has audited the accounts of an NBFC and there is a change in management, and sometimes SFIO, so they give notices or they call persons, they call professionals that you are an auditor, and because new management is no longer available or they have fled the country or things like that. So what is the precautions as an auditor a person can take? So this is my question. It can be taken up in subsequent sessions also. That is only I wanted to say. Thank you.
No, I think Gupta ji, this is a question which belongs to us. We are also chartered accountants, and we say one thing that it is not really it is not really a matter of a concern that the management changes. The matter of concern, according to your query, is that in case there is any kind of inquiry from SFIO or from CBI,
Yes.
we as a chartered accountant has to kind of cooperate with them. So therefore, what is advisable? It's all that all our auditing documents must be retained, and it should be seen by everyone that we have checked this part of the balance sheet and this part of the balance sheet and this part of the financial statements, and how we checked that. And for each and every checking, the audit notes must be protected and retained. That is what will save us. Errors by a chartered accountant are accepted, but in case there is any intentional errors, those are not accepted. So if there is an understanding difficulty or the hiding of the facts by the promoters or by the management, that will protect the auditor in case those audit notes are kept intact. Yes, Ankit, it is because you do audits every day. So you would like to add something on this?
I think yes, the audit documentation is very important, and the review of audit documentation by any investigating authority totally depends on how thorough are they with the duties of the auditor. There might be some investigators who go overboard and say that no, the auditor should have this also on record, he should have this also on record, which is basically going beyond the standards which are applicable to us. And there might be some who kind of are not having that knowledge and they don't even understand that. But for us as auditors and for any NBFC, I think it's a very important part of the audit process, to have a very thorough documentation, as Anil sir said. And I think nobody can say that the duty is moved beyond it. Now, the next step then, sir, is that how much is the auditor engrossed, or what kind of evidence is available for the auditor to be involved in alternative or other processes. Now, I see that many of the chartered accountants who get trapped in SFI or ED related affairs do not get trapped because of lack of audit documentation, but because of some kind of messages or some kind of evidence that they were part of the entire process. So that is also important, because these days digital forensics are at an advanced stage. Any document, any email, any WhatsApp message can kind of establish a relationship which authorities then can use against the person.
So
Thank you, sir. Thank you very much.
Good morning, everyone, and welcome back to our weekly webinar series. At episode number 171 today, we are starting the process of having a series of webinars to understand all the nitty-gritties of NBFCs in India. And we are looking forward to have a full study or a deep study into NBFCs affairs. Over to Anil sir.
Thank you, Ankit, and welcome to participants at this 171st episode of AAA weekly webinar series. Since we have started the individual short videos for judgments, so therefore for our webinars, we in fact had done a series of webinars on asset reconstruction companies. Now, if there is no further development into IBPI or regulations or insolvency law, individual judgments are being delivered by short videos. So therefore, it was appropriate for us to think about a series on NBFCs. To share with you my own surprise, NBFCs is a very, very large subject. It actually requires a study in depth. There are various regulations, there are various kinds of NBFCs, and it is important for any person who would like to develop financial acumen, or anyone who is actually working for an NBFC, dealing with an NBFC, and also all students. It is really going to be a series which might even continue for about between 5 to 8 webinars. Today, we are kind of deliberating on the what NBFCs are and how to, like, we will be exploring the various types of NBFCs operating in India, and also will be uncovering various features that actually sets the NBFCs apart from banking industry, that means banks. So going forward, we have this, first of all, like, we'll see what NBFCs really are, and then we would also see the jurisprudence or the kind of the journey that actually have seen NBFCs. So still, it is like, kind of, I would like to say that the law, it has often been said, evolves in response to the demand of society. So too, financial law, particularly in India, has undergone remarkable transformation since independence. When the society was demanding a kind of structure which is other than public sector banks, so at that time, NBFCs emerged. Then the government thought that these NBFCs, or these companies which are engaging in accepting deposits and giving loans, should also be monitored and controlled, so that the to control the risk factor of depositors. So this is how it started. The first, it comes like the companies were mushrooming, those companies which were accepting deposits and giving loans other than banks. So therefore, the need of the society was seen by the government, and therefore the regulatory changes were made. So this country, it was a very vast and diverse country, and it is a diverse and vast country. And in fact, the informal economies thrived, and the banking infrastructure was not always omnipresent at various small towns and villages. And also the law had to carve out an institutional space for a special kind of financial intermediary. So therefore, the NBFCs actually took took birth. So it was named separately. It was named later, but in fact, the NBFCs started emerging in the society much before the law and the regulation emerged. So the evolution of these NBFCs did not happen overnight. In fact, it is rooted in statutory interpretation, judicial pronouncements, and also a kind of keen regulatory insights into the financial inclusion. What exactly is an NBFC? I would just be reading my slides. The non-banking financial company is a company registered under the Companies Act. Either it should be 1956 or Companies Act 2013, and engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government or local authorities, or other marketable securities of like nature. Leasing, hire purchase, etc., as their principal business. But it does not include any institution whose principal business is that of agricultural activity, industrial activity, purchase or sale of any goods other than securities, or providing any services and sale, purchase, construction of immovable properties. A non-banking institution, which is a company and has principal business of receiving deposits under any scheme or arrangement in one lump sum or in installments by way of contributions or in any other manner, is also a non-banking financial company. That is also called a residuary non-banking company. Let us understand the legal definition of NBFC, which is the legal NBFC, the legal definition of NBFC, and that is where we can see in the Reserve Bank of India Act 1934. In fact, this was introduced by RBI Act. It was introduced by inserting a chapter which is called Chapter 3, capital B, and this was like introducing the provisions relating to non-banking institutions which were receiving deposits and also the financial institutions. Now, this section 45, capital I and clause C, in fact, defined financial institutions, and section 45, capital I, clause F of RBI Act defines non-banking financial company. The banking company as such is not defined by RBI Act. The banking company is defined, in fact, by section 5, clause C of the Banking Regulation Act 1949, which links it to the business of banking as defined in section 5, subsection B of the same act. There is another definition which is important, is again from RBI Act, that is section 45, capital I, clause E. Non-banking institution means a company, corporations, or cooperative society. And like in fact, this is a definition which is a detailed definition of financial institution, because see, in RBI Act, first of all, the NBFC is defined and then the financial institution defined, because the NBFC's definition itself contains the word financial institution. So the financial institution as such actually can be summarized in this table. These are also called the categories of NBFCs as per the legal definition. So this chart, which actually shows the activities which are considered as NBFC activities, and also the other activities which are excluded, that would not be considered as NBFC activities. Now, what activities would be considered as NBFC activities? That is loans and advances, like financing any activity other than its own. Then investment, acquiring shares, bonds, debentures, or securities. Hire purchase, delivering goods under hire purchase agreements or even leasing agreements. Insurance, any company carrying on insurance business is also called NBFC as per the definition of financial institutions. Chit fund, like all the chit fund companies, like managing, supervising chits or QRIs. So then the collective schemes, there are collecting money through subscriptions, awarding gifts, prizes. All this is called the NBFCs by categories. And then, like, what are the activities, what are the principal businesses which will not be considered as NBFCs? The agricultural operations, industrial activity, purchase of goods and purchase and sale of goods and providing services, purchase, construction, or sale of immovable properties. Then we also would like to see this. In fact, non-banking financial company is as defined in clause C of section 45, subsection capital I. It says a a financial institution which is a company. So one thing which is important for NBFC is that it has to be a company, maybe a private limited company or a public company, but it has to be a company to be an NBFC. Then a non-banking institution which has its principal business either a non-banking institution. First of all, it should not be a bank. It should not be a bank. We will cover today what is the difference between bank and NBFC. So it should not be a bank and which has its principal business either receiving of deposits under any scheme or arrangement or in any form, lending in any manner whatsoever, such other business as may be specified by the RBI, which with the prior approval of central government. So that is where the principal business is this, and it's a company. So that means it's a financial. It's an NBFC. Now there is although this was not part of the act, this was not part of the regulations, but by way of a press release which was dated 8th of April 1999, in fact, RBI introduced a principal business test, because see, once in case we see this slide, we actually see the NBFC can be categorized as principal business. So based on its principal business, the NBFC can be categorized as NBFC because there are many companies which are engaged in various activities, including those activities which are not covered for NBFCs like agricultural, manufacturing, trading, building, construction. All this is like, so these are, so therefore the NBFC can only be like kind of, you see the first test is that the 50-50 test, which is as per the RBI notification. So this notification of the RBI which says, first is the financial asset test. Now, the financial asset test means if more than 50% of total assets, more than 50% of total assets must be financial assets. So we will also define the financial assets means like loans, advances, the investment in shares, all this that we have seen in the business activities of NBFC are the business assets or the financial assets. That's like the excluding intangible assets. So the total assets of a balance sheet, if it is say 100, excluding intangible assets, and if 50%, more than 50% assets are financial assets, then it can be considered as an NBFC if the second 50 test is also met. Now the second 50 test is income tax. So where the more than 50% of the gross income must come from financial activity. So both these conditions are required to be first. Both these tests are must. Then only a company can be considered as NBFC and will require the certificate of registration from RBI. Otherwise, it will be a non-compliant company. So both the tests are must, and this numerical test, though not enshrined in the statute, has been judicially acknowledged and administratively upheld because of this press release dated 8th of April 1999. Now, the dual standard means asset as well as income standard ensures that the entities do not escape regulations merely by manipulating asset classification or income timing. So therefore, both these tests are important. So therefore, this is a dual test. This actually is to identify a company and also to identify whether this company needs a COR, certificate of registration, or not. Now, let us understand what is the difference between NBFC and banks. In fact, not much of the difference, a very, very small difference, that the NBFCs, it may look like banks because like banks, the NBFCs also receive deposits. NBFC also give loans, advances. So whatever bank does, NBFC is also doing, but the NBFC cannot do three things. One, it cannot accept demand deposits, means the saving account and current account. The saving account and current accounts are considered demand deposits because the depositor can take out the money at any point of time by issuing a check. Then the NBFCs cannot offer checks. NBFCs cannot offer checkbook. It cannot offer that any kind of checks would be issued or received. Then is the deposits of NBFC are not guaranteed by DICGC. So the deposits of banks are protected by an insurance cover called DICGC. However, the deposits of NBFCs are not covered by DICGC guarantee. So, but in everything, especially lending, NBFCs are more agile, faster, and often more flexible than traditional banks. That is the reason that the growth of NBFCs has actually been tremendous in the last 25 years. Because you see, like in the beginning, it started somewhere in 1966. We will actually come to the evolution of NBFCs in India, and therefore we can say slightly different in a very, very common language. The banks can be considered as formal hospitals full of rules and systems and protocols, whereas the NBFCs actually can be considered as expert clinics, smaller, quicker, tailored to the patient. Now, why it is called expert clinics? Because see, there are NBFCs which are only doing leasing or hire purchase. There are NBFCs, they are only doing microfinancing. There are NBFCs, they are only doing gold loans. So these are expert clinics, like we have the clinics for eyes, clinics for ear, clinics for the neuro. So this can also be a very kind of, and there can be a multi-specialty kind of a hospital. So the banks can be compared with a formal hospital with full of rules and systems and protocols, whereas the NBFCs are expert clinics. That's in a very, very general kind of comparison. Now we need to understand the journey of NBFCs, from like kind of bystanders to backbone. And as I said, that the business of NBFC, in fact, was in existence since centuries, because the giving loans and taking deposits, the Mahajani business, our villages, in fact, have seen these Mahajani business. They actually was taking money from those who had money, and they were lending it to farmers and also other people. Also, the goldsmiths, in fact, were good in giving loans on gold mortgage. So this business of giving loans, in fact, was prevalent like since various centuries. And then came the regulation requirement. So the first genesis that we can see is between 1960 and 1980. That is the origin and the early role. And in fact, for the first time, the RBI gained statutory powers to regulate NBFCs with the insertion of Chapter 3B in RBI Act 1934. That was done on 1st February. That was effective from 1st February 1964. 1st February 1964 was the first effort actually that was made by the government to regulate NBFCs. However, recognizing the growing importance of these entities, and particularly those accepting deposits from public and engaging in quasi-banking activities, like then the Banking Law Miscellaneous Provisions Act 1963 was introduced, and the RBI issued the Non-Banking Financial Companies Reserve Bank Directions 1966. So first, RBI got this power by inserting Chapter 3B in RBI Act, effective from 1st February 1964. Then another law came, which was Banking Law Miscellaneous Provisions Act 1963. Then was the NBFC Reserve Bank Directions 1966. So that is what is the starting of the era of NBFCs, and that what in fact this marked the beginning of the formal oversight in a sector that was largely informal. So it was amid rising defaults and depositors' rates, RBI issued the non-banking companies Reserve Bank Directions again in 1977. And while the government introduced companies acceptance of deposit rules 1975 under section 58 capital A of the Companies Act. So this is what in fact the origin and the kind of genesis that we could see in between 1960 and 1980. So between 1960 and 1980, in fact, many things happened. One, that the RBI got the power to monitor this sector. Then Banking Law Miscellaneous Provisions Act 1963 was introduced. Then non-banking companies Reserve Bank directions were issued in 1966. Then in 1977, the non-banking Reserve Bank again issued directions. Then the company's acceptance of deposits it was issued in 1975 as under Section 58A. Now, coming to the next era, and in 1990, then it came to the liberalization and rapid expansion. At that particular time, the Narasimhan Committee 1991 and A.C. Shah Working Group made some recommendations like entry point capital norms. At that particular time, it was required, it was felt that all these NBFCs should have the some entry point capital norms. Then there should be some minimum net owned funds also. That criteria should also be laid down for NBFCs. Then recognition of the NBFCs as complementary to banks. That was also the recommendation of Narasimhan Committee, because it was also felt that the need of the society is much more than what is being met by the banks. And especially at that time, it was more or less Punjab public sector banks, and the private sector banks came later. So at that particular time, the gap in the need and the supply was, in fact, it was tried to be met through the NBFCs. Then at that particular period, the RBI even, see, between this, the chapters of chapters 3B, chapters 3C, chapters and chapter 5 of the RBI Act, NBFCs were formally classified into deposit-taking NBFCs, which is NBFC-D, then non-deposit-taking NBFCs, that is NBFC-ND, and then core investment companies, which is CIC. So these were the three categories made at that particular time, broader activities. And NBFC's acceptance of public deposit directions 1998 came into effect, setting standards for deposit-taking activities. So this is what has happened in the 10 years, starting from 1990. So therefore, we actually can see what actually happened. So first era we saw, and then the second era based on this Narasimhan Committee and A.C. Shah Working Group, where it was the entry point capital norms, then the minimum net worth, and the recognition of NBFCs as complementing to the banks, and then bifurcation of deposit taking, non-deposit taking, and the core investment in companies. Going forward in year 2000 onwards, then we actually saw the structured classification and risk-based norms. Structured classification and risk-based norms. So there, in fact, the classification framework, in fact, showed that the classification of NBFCs into deposit taking and non-deposit taking. Then in this particular era, the prudential norms was also introduced, exposure norms, credit concentration caps, and corporate governance framework was also introduced. Then systemic importance NBFCs enhanced scrutiny on systemically important NBFCs. So that is also called NBFCs ND, which is non-deposit taking, and then SI, systemically important. So this was the concept introduced after 2000, and then the framework, in fact, reduced regulatory gaps and helped rebuild market trust. So therefore, the RBI master directions and Thorat Committee recommendations 2011 formalized sectoral guidance. So this particular time, RBI's master direction and Thorat Committee recommendation 2011, in fact, got formalized. And in 2010, because see, we actually bifurcated the journey into like first 20 years and then 10 years and then 10 years. So in 2010, we actually saw the digital acceleration and retail domination. So in this particular era, we actually saw that the NBFCs, in fact, embraced digitization and technology to streamline operations and reach previously untouched borrower segment. The NBFCs reached to tier 2, tier 3, and tier 4 cities. And also MSME became the key focus area for NBFCs. Their lending portfolios, in fact, diversified into consumer finance, microfinance, gold and two-wheeler loans, and affordable housing. In fact, the NBFCs partnered with fintech companies, the financial technology fintech companies, and they also kind of started depending on their decisions on alternative database where the credit scoring, the CIBIL and other credit information companies were being used for the due diligence of the prospective borrower. Then for quicker disbursement of loans, the video KYC and the Aadhaar-based e-signing and also the e-Nach. So all this was introduced only to give and disburse loan within minutes, not in days, within minutes. So this e-Nach, in fact, was again an introduced, which is system ENACH, means the Electronic National Automated Clearing House. Electronic National Automated Clearing House, where basically the automatic loan repayments can be established and it can be mandated. It is for the NBFCs that provide loans, personal loans, business loans, vehicle loans. So then ENACH, ENACH is widely used presently also to set up automated monthly installments, EMI. So from the borrower's bank account. This actually ensures timely and consistent collection of payments without manual intervention. Efficiency and convenience is very high. Reduced defaults rate has been seen by the NBFCs in case they are kind of implementing ENACH. Then paperless process, because there is no check, there is nothing which is required. And then, however, this particular, in case this debit mandate is rejected by the bank because of no funds available in the bank account, there is no criminal liability under Section 138 of the Negotiable Instrument Act. So that is also one AC importance, because this ENACH, Electronic National Automated Clearing House system, which is used for payment of EMI, was also a little bit of risk-free for the borrower. Then API integration, like we also have seen the API-enabled loan disbursement, maybe various retail organizations, they in fact get the loan disbursed, and there is a API integration between so-called Bajaj Finance and other retailers, and then the loan can be disbursed in minutes. Loan can be disbursed in minutes. So that was the scene in 2010, and then post 2011, in fact, we also saw the regulatory consolidation and systemic importance. When this systemic importance came, and then in fact it was also because of this Usha Thorat recommendation and the working group under Usha Thorat, when they actually said that the growing scale and complexity of NBFCs, so therefore it should be systemic importance should be seen. So the business classification was supposed to be revisited because of this, like Usha Thorat committee. It was recommended that the business classification should be revisited. Then governance framework, like strengthening governance and disclosure norms, financial stability like liquidity buffers and entry point restrictions, that was also recommended by Mrs. Usha Thorat working group. So many of these ideas were adopted in draft guidelines issued in 2012-13, laying the groundwork for future reforms, And when we actually come to 2020, systemic relevance and RBI's new framework that in fact ruled after 2020, where the assets under management exceeding 50 lakh crore, the NBFCs actually became too significant to ignore. So the country was having too much business with NBFCs. So it was almost a younger sister of all this banking industry. So therefore, the RBI thought that it is very, very important that this segment should also be further controlled, and to also to address the very, very rising systemic risk and regulatory arbitrage. The RBI, in fact, implemented scale-based regulatory framework. Scale-based regulatory framework, in short, SBR. It was introduced in October 2022, and presently it is active, and most of the compliances are based on the category of the company, based on this SBR, scale-based regulatory framework. And there is a top layer, which is presently, there is no company which has been classified in the top layer, and the RBI will notify what all companies will go to top layer. Then is the upper layer, which is systemically important, and presently there are about 15 companies which are systemically important. It's identified in the upper layer by the RBI. It is specifically identified by the RBI. It is not something which is based on a particular figure or a particular asset under management or under, but then this is something which is specifically identified by the RBI. So there are about 15 companies, which even includes, as of now, the LIC Housing Finance Limited, Bajaj Finance Limited, Shriram Finance Limited, Tata Sons Private Limited, Student Finance, and many other. And then comes with the middle layer, the NBFC ML, and the NBFC UL and NBFC ML. Now, in the NBFC ML, which is moderate sized firm, generally includes all the non-deposit taking NBFCs with an asset size of 1,000 crore and above, and all deposit taking companies. All deposit taking companies are categorized in NBFC ML, and deposit taking companies where the asset size is 1,000 crore plus, those actually will be considered in the scale-based regulatory framework, systemically important. So therefore, the middle layer, ML, is applicable to any company which is accepting deposits. Second, a company not accepting deposit but manages an asset size of 1,000 and more asset size. So those are all middle layer. All residual companies are considered as base layer. All residual companies are considered as base layer. So what are base layer? The base layer is, since there is no top layer company, so we can exclude this category for the time being. Then exclude the 15 NBFCs which are specifically picked up by RBI to declare them as systemically important NBFCs. Then this middle layer with the condition of non-deposit taking but 1,000 crore plus, and all deposit taking, and all rest of the companies will be under the smaller and lower risk, which is a base layer. So this is as per the RBI's 2023-24 trend. SBR is based on principle of proportionality, with the regulations commensurate with the size and interconnectedness of the NBFCs. So this is the SBR, means scale-based classification or regulatory framework. We actually will have one or two slides more. Or Ankit, would you like to connect here with the audience with your comments? Otherwise, there are 3-4 more slides which actually will show the evolution of NBFCs and regulations in India. Or you can even give your comments at this moment.
We have an anonymous question which says that whether an LLP is required to obtain NBFC registration to carry on business of financing. So I think
No, no,
this
the
query.
NBFCs are not entitled for a COR, the certificate of registration, because the LLP cannot become NBFC.
So the question then becomes that can LLP do a lending business?
Then it comes the non-banking institutions. There are separate regulations for non-banking institutions, but
I think
not will not.
you will come to that then I think over time. But yes, with respect to companies, we are very clear that yes, there is a provision which kind of identifies entities which are doing NBFC like business, and then of course there's a control mechanism to make sure that only larger entities are able to do that, and they are also then under the umbrella of regulations of RBI. So I think that's it. We have another question from advocate Mr. Garg. He says Money Lenders Act also exists. Can you explain if money lenders would be governed by RBI Act as NBFC? So
No,
I
we
think
will
he
be
also
covering all
wants to
this.
talk.
We will
So
be
he
covering
will,
all
yeah,
this
we
like
will
money
talk about
lenders.
it over time. Yes.
We,
So maybe back to you. I think we can go ahead and take it forward.
yes, I said the Money Lenders Act also we would be covering,
Yeah.
and we will differentiate what exactly is Money Lenders Act, and in that Money Lenders Act, in case that the financial institutions uh, will be covered. Like NBFCs are only private limited or limited companies, and there can be another non-banking financial institutions that we will cover how the LLPs and partnership firms can actually be covered under what kind of RBI laws. In case partnership firm or LLP starts doing the same business as NBFCs are doing, then what are the compliance requirements they are supposed to do? That we will also come back in the series of this NBFC kind of educational series. Now, like in 2023, very recently, the codification of the scale-based regulations framework into the main master's direction. So then in this particular in 2023, in fact, to institutionalize the risk-based approach to NBFC regulations, the Reserve Bank of India, in fact, issued a comprehensive master directions, which are titled as Master Directions RBI Non-Banking Finance Companies Scale-Based Regulation Directions 2023. It was issued on October 19, 2023 under sections 45I, capital A, 45J, capital A, 45L, and of the RBI Act. Now, these master directions, in fact, formally supersedes the earlier 2016 directions for systemically and non-systemically important NBFCs and became the central regulatory framework of all NBFCs and scale-based regulation model, SBR. So we would be focusing on this master directions for NBFCs and that to scale-based regulations and different compliances requirement and different the kind of capital adequacy or various ratios requirement that we would be discussing on this particular directions 2023. Now, with this kind of regulations, we definitely would like to say here why NBFCs are important. So in financial year 2024 and 25, as on December 24, in fact, the 52 lakh crore was the size of the balance sheet of NBFCs in India. And it is likely to be projected at 60 lakh crore by financial year 26. The NBFCs have seen 20% credit growth in the past few years, and it is basically year on year, which is outpacing the banks. The banks have seen only 12%, NBFCs have seen 20%. 50%, 58% of the lending of the NBFCs have gone to the retail lending share, and of the total loan growth is 58% is the loan growth of the lending, the retail lending shares. 19% is the MSME lending, which is actually grew at 19% CAGR, compounded annual growth rate was there, and the asset under management projected at 5.3 lakh crore by financial year 26. 5.3 lakh crore by financial year ending on 26. 12 to 14% growth was seen in microfinance, and it was under stress. And the in fact asset under management was declined between 12 to 14%, because in fact the microfinance companies in fact grew a lot. It was a kind of unprecedented growth that we saw a couple of years back. And then in the financial year 25, the microfinance was under stress. The asset under management declined. However, the recovery is expected as per the information available virtually online. The recovery is expected in financial year 26. Then you see, like when we see this a kind of a chart that we can see what exactly the journey has been, the journey of NBFC regulatory timelines that we can say in 1964, Chapter 3B was added in RBI Act. And the significance of this particular amendment was to give powers to RBI for regulating NBFCs. In 1977, non-banking companies directions were issued by RBI. That was first structured RBI directions for NBFCs. In 1991, Narsimham Committee was set up, and it was recognized by the committee that NBFCs as complementing to banks. In 1998, NBFC acceptance of public deposit directions, it was only to tighten the deposit accepting norms. Between 2006 and 10, systemically important NBFCs identified and risk-based regulation begins. It started. In 2011, the Usha Thorat Working Group, in fact, they recommended governance reforms and liquidity norms for this. In 2016, Master Directions regime launched, unified updated framework across NBFC types. In 2017, Master Directions for peer-to-peer, and then its AAS, the CIC, MGCs, that was also introduced and responded to fintech and group entity needs was fulfilled. In 2018-19, the ILFS and DHFL crisis came, where it was like the government shocked, and it triggered the urgent focus on liquidity and asset liability mismatches. So the liquidity crisis and the asset liability mismatches happened in ILFS and DHFL, and therefore in 2020, the liquidity coverage ratio was introduced for NBFCs. LCR was introduced for NBFCs, so only to strengthen financial stability requirements. In October 2022, scale-based regulation SBR framework announced, and four-tiered regulation based on systemic risk was introduced. In October 2023, systemic scale-based regulation master directions issued, because this particular direction supersedes older non-deposit taking or systemically important companies' directions that was superseded. November 2023, IT governance directions released, and that enhanced cyber and operational risk standards. In February to June 2025, updates to deposit directions, microfinance, MFI qualifying assets, and the bank NBFC financing norms, and final alignment with the scale-based regulations and tech-led credit ecosystem. So presently, let us understand, like as recent as February and June 2025, so there are deposit directions. The MFI microfinance is again something which is a need of the country. And then bank NBFC financing. Bank financing to NBFC is also something that actually needs some kind of directions. Then final alignment, which is the scale-based regulations and the tech-led credit ecosystem, where the loans are being given within 5 minutes because of the total due diligence, which is automatic, which is digital, digit-based. So Ankit, this is the total journey that we have so far as far as the NBFC is concerned. And then finally, when we come to this, after this journey, we have seen that the NBFCs, presently there are something like 9,300 NBFCs registered with RBI as of March 2025. Now, in case we see the balance sheet total, the NBFCs are in fact managing the balance sheet assets of approximately 28.2 lakh crore with 24.5 lakh crore in the net advances. Then, in case we see the credit share, they account for 24.5% as per the RBI trend report 23-24 of total credit extended by the bank. So let us understand the out of the 100 the total loans in India, out of the 100, the 25% area, 25% are met by NBFCs, and which is growing, and this share is also likely to increase further. Now, the NBFCs, in fact, have served various key areas like housing finance, vehicle loans, MSME financing, gold loans, and microfinance. Their core strength of NBFCs have been last mile credit delivery, effectively reaching tier 2, tier 3, tier 4 towns, and rural area where traditional banks probably have not their presence. And then the regulations like NBFC, the new age NBFC framework, which is the NBFC when they grew bigger and they become systemically more important and more risk prone. So therefore, they are even some of the companies are equal or but more in size as compared to some mid-sized banks. So therefore, the scale-based regulatory framework was introduced, and as we have already explained, base layer, middle layer, upper layer, and top layer, and therefore this is these are something which is the evolution of NBFCs. And in Ankit, we can take some questions, and then we actually will understand in our next episode the diversity within the NBFCs, like the first the business activity wise bifurcation of NBFCs, then the accepting deposit or not accepting deposit kind of bifurcation, then the systemic importance and systemic significance, that we will start in the next episode. In the meantime, I believe there are some questions and there are some participants, they want to ask some questions, or they want to say something, or they want to add something.
So I think we
Yes,
have a
Ankit.
question. We can take up all these questions one by one. So Manvi Jainji is asking that NBFCs cannot accept deposits, that is saving and current accounts. Then what are deposit taking NBFCs? So I think
No,
we
they
can
take
say,
term deposits.
so they take term
Yes, Ankit.
deposits. You will also see that they raise funds through issue of various debentures. You will see that a lot of NBFCs have public issue for debentures and other mechanisms through which they can raise these funds. So, of course, saving bank and current accounts is something that is exclusive to banking. So that's not something that they can do. Then we have a question that how to check if any entity has been classified as NBFC or not. Can bank initiate IBC against NBFCs? So NBFCs, whether they're classified as NBFCs or not, they're listed on RBI's website. So one can easily find those companies that are registered as NBFCs with RBI. Number two, in case we talk about IBC, IBC against NBFCs is limited to RBI sanctioning or approving such action. It cannot happen directly from a creditor. So that's the basic logic.
So, but I think this question is very important if we understand what actually she's asking. If an NBFC is doing the NBFC business based on that 50-50 model of RBI, but have not got it registered as NBFC, so the certificate of registration has not been taken. Now, in those cases, can the insolvencies get started? Yes, my answer is yes. If a company is not registered as NBFC, if the certificate of registration is not given by I, then company is prone to IBC risk. And if there is a default, certainly IBC can be initiated against this company.
Then we have a question that are benefit funds termed as NBFCs? Benefit funds. I personally am not. I don't understand
Benefit
these
fund,
funds.
I think we need to get some more information about the question. This
These benefit.
benefit, we actually can note down, and if the benefit funds we will cover in our the future episodes, so upcoming episodes. If there is anything like benefit funds, we would understand that. So far, we haven't read anything called benefit funds.
If there is only income from investment of FD amount, can it meet 50% income from financial assets? So Suchita ji is asking that if there is a company and that company is only earning FD income or income from FDRs, does that become financial assets?
See, like as far as this 50-50 RBI test is concerned, if there is any company which has only assets, but then RBI would have given some exemptions to various companies where there is no business activity, but only a smaller investment activity is going on. And in that investment activity, even the income is also coming from financial assets. And but then there are still, we actually will come up in the next episode, like in case such companies does not get itself registered with RBI, then what are the adverse implication on this company? That we will cover in the next episode. Because the next episode, we are actually covering the requirement of COR, Certificate of Registration. So we'll come up to the next. So we don't want to take a question which, in fact, we will have into the follow-on episodes.
So there's also a question on housing finance companies that, of course, we will cover later. I think benefit funds, they mean chit funds. So chit funds is
We've said already this, we've covered that the chit funds are NBFCs.
Yeah. We have a raised hand from Naveen ji. We can allow him to talk. Naveen ji, you can just unmute and say what you want to say. Mr. Naveen Bhatia. Maybe he raised his hand by error. I don't see an activity there. So can NBFC become an ARC? Another question.
Now, ARC is a completely a separate registration. Most of the companies, they have in fact decided to start a new ARC company. But when I was reading the ARC law, even an existing company it was possible to convert that existing company into an ARC. But once the company becomes ARC, then there are restrictions that what kind of business the company can do. So those restrictions will apply.
So then another question from Ravi Kiranji is operating leasing activities are coming under regulatory purview of RBI. Where one does operating leasing?
No, actually the operational lease, which is not a financial lease, is not considered as the NBFC. Now, if a company is engaged into a business where the company has kind of say 50 cars, and the cars are being given on rent, so then it is being charged. Like there are companies, they are giving cars on lease to banks on monthly basis. So there are companies, they are giving generator sets on lease to various people. So these are the companies which actually are not considered as financial lease as per the definition of as per the accounting standards. But these are operational lease. So the operational lease companies are not NBFCs.
So there is a question from Divakaran ji. He says, what are the practicing areas of professionals in NBFC sector? I think there are many, and I think we will also be covering that in this entire series. We will, of course, talk about where all do NBFCs need support and need
So there are various compliances that is required, and chartered accountants, there are compliances for valuation, valuers, there are requirements. So we are coming up with the different episodes for, because see, this is something which is, I think all my participants, they should spread around that anyone who actually is interested in NBFCs should actually log in for this NBFC series. Because see, this segment has actually grown very large. The information to all of us is very limited. And now we, including our team, are working very hard to compile all the information and deliver it in kind of in capsule manner. The different kind of categories of NBFCs, and then different kind of requirements and different kind of compliances requirements, and what are the opportunities for businessmen, what are the opportunities for professionals. So that is what we finally would be deliberating on. And in case our audience would like us to focus on few points related to NBFCs, we would welcome their suggestions.
So I think we have one more query that has come from Mr. Rajan. He says, what is the scope of probability of consolidation in the NBFC sector? I think that's the only question. We can quickly answer that and then wind up today's session.
So consolidation, see, like presently, like it is my own, one R.K. Gupta has also raised hand. My own understanding is that there is a mushrooming in NBFCs as of now. Especially we have seen mushrooming in microfinance companies. And whenever there is a mushrooming, there has to be a consolidation. Presently, RBI is very, very kind of selective in kind of directing the insolvency, start of insolvency, because it is impacting the depositors. So we can see that in coming period, RBI will also identify more NBFCs where the insolvency would be started as ILFS and DHFL. We can see that, and that is what we can see, that not a really, really healthy scenario, but yes, identification of NPA, identification of default, evergreening. So these are some of the issues in the NBFCs. I think the RBI is like appraised of this situation, and maybe they would wanted to do these two test cases, and they will again, after the learning from these two test cases, the RBI will see whether supporting those NBFCs would be required or making them insolvent would be the requirement of the society. That is what the RBI would see. So when we mean the consolidation would either come from some more examples like ILFS or DHFL, or the support from RBI to kind of some of the NBFCs under stress. Yes, Ankit.
No, I think yes, we have also experienced working and valuing a very large loan portfolio of one of these sick NBFCs, and we were able to see how the entire process of financing the amounts from government-related organizations or government lenders was totally fraud-driven. So yes, many a times under the umbrella of that yes, it's digital, and yes, there are advanced processes in place, NBFCs can kind of create those kind of bouquets. But yes, today I was talking yesterday to a large ARC, and they were saying that a lot of NBFCs are also now making bouquet of various loan portfolios, and they are rather quickly sharing them with ARCs and using ARCs specialization to deal with such realizations for retail loans. So yes, I think that is happening there. I think we will take it forward next time. We have another raised hand from R.K. Gupta ji. I will just quickly ask him to share what he wants to add.
First of all, very good morning, Anil Goel ji and Ankit Goel ji. I hope I am audible.
Very much.
Yes, you are audible.
Okay.
Thank you.
So the only question I would ask is that at times there is a change in the management of NBFCs. And being an auditor, basically this question is from an auditor's perspective, that if a person has audited the accounts of an NBFC and there is a change in management, and sometimes SFIO, so they give notices or they call persons, they call professionals that you are an auditor, and because new management is no longer available or they have fled the country or things like that. So what is the precautions as an auditor a person can take. Though this is my question, it can be taken up in subsequent sessions also. That is only I wanted to say. Thank you.
No, I think Gupta ji, this is a question which belongs to us. We are also chartered accountants, and we only like to say one thing, that it is not really it is not really a matter of a concern that the management changes. The matter of concern, according to your query, is that in case there is any kind of inquiry from SFIO or from CBI,
Yes.
we as a chartered accountant has to kind of cooperate with them. So therefore, what is advisable? It's all our auditing documents must be retained, and it should be seen by everyone that we have checked this part of the balance sheet and this part of the balance sheet and this part of the financial statements, and how we checked that. And for each and every checking, the audit notes must be protected and retained. That is what will save us. Errors by a chartered accountant are accepted, but in case there is any intentional errors, those are not accepted. So if there is an understanding difficulty or the hiding of the facts by the promoters or by the management, that will protect the auditor in case those audit notes are kept intact. Yes, Ankit, it is because you do audits every day, so you would like to add something on this?
I think yes, the audit documentation is very important, and the review of audit documentation by any investigating authority totally depends on how thorough are they with the duties of the auditor. There might be some investigators who go overboard and say that no, the auditor should have this also on record, he should have this also on record, which is basically going beyond the standards which are applicable to us. And there might be some who kind of are not having that knowledge and they don't even understand that. But for us as auditors and for any NBFC, I think it's a very important part of the audit process, to have a very thorough documentation, as Anil sir said. And I think nobody can say that the duties moved beyond it. Now, the next step then, sir, is that how much is the auditor engrossed, or what kind of evidence is available for the auditor to be involved in alternative or other processes. Now, I see that many of the chartered accountants who get trapped in SFI or ED related affairs do not get trapped because of lack of audit documentation, but because of some kind of messages or some kind of evidence that they were part of the entire process. So that is also important, because these days digital forensics are at an advanced stage. Any document, any email, any WhatsApp message can kind of establish a relationship which authorities then can use against the person.
So
thank you, sir. Thank you very much.
Right, sir.
Yes, thank you. So we can conclude the episode 171, and thank you very much for participating. This is our way of learning.
Everyone, thank you.